Vetiva, in his equities market outlook forecast for the second half of the year, say that they remain cautiously optimistic, and that view is hinged on continued implementation of market-friendly measures and ongoing economic reforms. Ifeday Olowoporoku, Senior Portfolio Manager at Vetiva, joins us now to get some perspective on the outlook for the market. It's a pleasure to have you on the program today, Ifeday.
Thank you for having me.
So clearly, very strong Q2. The big question is what happens next. And I guess there's always that caveat about what happens now that the new government is in place. What are your overall thoughts about the likelihood of a further catalyst moving forward into the second half of the year?
Thank you for the question, and thank you for having me. So, like you said, cautious optimism. There is still optimism for the equity market. The general expectation is that we're going to close the year positive and very strong. The upside might be limited now because we have seen stocks significantly rally. So far this year, we've gained north of 25%. It's the best performing asset class, really. So there's still upsides. There are expectations that we will see the fruits of some of the policies and reforms that have been implemented, but it's cautious because a lot of things keep changing. There is still a lot of focus on the exchange rate, which is a big determinant on what will happen with capital flows to an extent. So I think market is really expecting the political clarity that came. We're still trying to see and make sure that there is also going to be a lot of policy clarity and stability. No doubt,
the situation around the foreign exchange market is a big concern for investors. And of course, that has implications for when we would see more flows from foreign portfolio investors. But beyond that, I think when you look at the macro story, there are still concerns about inflation, which continues to rise. Clearly, the removal of the fuel subsidies is one that is adding more pressure to that. How concerned are you about the macro stability moving forward?
Yeah, I think that's such an important picture, and I think we're currently in the middle of the first monetary policy committee meeting since the new government took over, and I think it's a really important meeting to really gauge the body language of the government regarding interest rates, because with the skyrocketing inflation, you would expect that there will be some level of tightening of liquidity and ensuring that the supply of money and interest rates are high enough to curb and anchor this inflation. However, what we have seen is that rates have been low and there has been ample liquidity. So I think a lot of market participants are looking forward to this meeting to see the body language, to see what the government exactly is going to do, or the monetary authorities will do with the benchmark rates. And I think it's important for how the equity markets will perform as well. There's sort of been, there's historically an inverse relationship, and that's why the previous quarter, like you mentioned, very strong performance for the equity markets, but when you look at yields in the fixed income market, they've really just gone down.
And in terms of getting exposure to equities, now that equities are exciting again, if you like, clearly the one approach will be exchange traded funds, and maybe we can touch on that very briefly in terms of how investors can get exposure to the market and the liquidity around that
100%.
asset.
It has been very exciting because what you notice is that, of course, the exchange traded funds are built to sort of mimic the underlying performance of the securities or the index that they're tracking. So what you have seen is that as the market has performed well, you've seen exchange traded funds that track the market also perform very significantly, and that just means you get exposure to the performance of different sectors in the market with investments in, just certain securities. For example,
what about liquidity, though?
Yeah, I think that's also important because you have also seen a lot of institutional interest, and typically that the institutionals are the major parts of the market. So you have seen that liquidity has also improved, apart from the fact that you obviously have your market makers, but there's also been a lot of activity because everyone wants to buy into the performance of these exchange traded funds. For example, the Vetiva Griffin 30 index has very well mirrored the performance of the NGX 30, and I think the most exciting is the Vetiva banking index ETF. It mirrors the NGX's banking index, and I think it has performed north of 60% so far this year. And, you know, that's one security, and you're getting exposure to the top and most capitalized banks. So it's quite exciting, and I think that there's been more focus on that particular investment option. Obviously, because the market, the equities market, is performing so strong, and the outlook is still very positive.
The banks, as you just rightly pointed out, have done extremely well over the last few months. The big question is, where do they go from here, and what are the risks associated with investing in banks? Let's touch on that sector for a moment. What's your outlook for banks?
Yeah, so I think that, you know, at the top of the year, there was a lot more optimism. We have seen rates come off, and, you know, typically when we're in a higher interest rate cycle or environment, that's very positive for banks and their yields on assets. But, you know, it still remains positive because a large number of the banks are long on USD. So even as we have seen the exchange rate cycle, a lot of the banks are still expected to turn in good performances. I think first FBNH reported recently, and their performance was quite good. So I think the outlook is good. There's some expectation that there will be increased focus on, you know, creating risk assets. But because, you know, you have an economy that is really, will I say, reeling from a lot of cost pressures, there's also a sense of caution as to the sectoral exposures that, you know, the banks allow themselves to take. So I would say that the performance of the banking sector really mirrors the macro to a great extent. There's optimism, but then a lot of caution as well.
And so outside the banks, moving forward, which sectors and stocks do you like?
So I think that because there are some certain sectors that are fundamentally you know, strong in terms of looking at secular trends and how the economy moves. So you still have the telecoms sector that is still very much, you know, positive, and the growth there has been strong, even irrespective of a lot of the cost pressures that consumers have come under. You expect some level of defensiveness from that sector. The oil and gas sector has also become a bit more exciting, and you've seen investors increase allocation to that sector, obviously post deregulation and just a general macro global view of that market that is more stable than where we're coming from. And then industrials as well, I think there's a bit of cautious optimism because you do expect that there would be a lot of capital spend, you know, with the new government, and a lot of focus on fiscal policy as well. So I think those sectors, with the consumer goods sector, is a bit more tricky because, of course, consumers have come under significant pressure. And, you know, those companies are also very much exposed to foreign exchange, you know, imports, or even just liabilities. So their earnings, because earnings season for H2 is already underway. So there is, you know, there's a bit less optimism for the stocks in that sector. So I think across those, we're positive.
Well, it sounds great. It feels great right now. But for me, I'm always thinking about the substance of the reforms. So clearly, we had to remove the subsidies. We've seen that we've made some movement in the FX policy, but we still have to wait to see the outcome of all of that in terms of investment flows and activity. But we'll see what happens. Thank you so much for your perspective today.
Thank you for having me.
Of course, that was Ifeday from Vetiva giving us her perspective on the outlook for the markets here in Nigeria.